All right, let's move on and talk about another theme. Now, oil marketing companies were in focus because we've seen a big fall in crude prices. So the question is, will the street look through the Q2 inventory loss and bet on a solid Q3? Nigel, what are the numbers telling you?
Well, Manish, I want your view on these OMCs. I'll just put out the piece and we get your view out there. So for the last week, in fact, there were a couple of triggers that played out in favor of the OMCs. One is that there was no escalation of the global tensions, the geopolitical tensions. And that's where we saw that crude oil prices did cool off because Israel says that they are unlikely, or the indications are they're unlikely to hit Iran's oil infra, which is good news. And that's why you saw crude oil prices that soften. The other point was everyone was worried whether or not we'll see a petrol price cut. Now we have the code of conduct that's kicked in for the states that are going to elections. So that's unlikely to be the case. So that's good news as well, both on the input side as well as on the selling price side. Now, moving to the inventory loss. For the coming quarter, there's going to be a hit. So you brace yourselves for that. And that's the broad estimates that have come in, that there is going to be an inventory loss because crude oil prices did correct substantially in the second quarter. The question is, will the street look through these inventory losses in the second quarter and brace for a solid showing in quarter three? Why do I say that? Because the refining GRMs, they have been under pressure, but that's a well-known thing. The important part is the marketing margins have now started moving up. And marketing margins in the last few quarters, well, they've been in that vicinity of around 3 to around 6 rupees odd. As of latest count, it's close to around 10 rupees. And the marketing margins have improved drastically, which could brace these companies for a very, very good showing in the third quarter itself. And when you're looking at, the companies, all the three OMCs, you look at the marketing volumes in comparison to the refining volumes. And by that stretch, HPCL appears best placed because the amount of marketing volumes are much higher. And that's for BPCL as well as IOC. So that's another trigger to track with regard to the marketing volumes being much more than the refining volumes, because we know the refining GRMs have been a little bit subdued. Now, valuation-wise, well, these companies are trading in those mid-single digits, close to around 6 to around 8 times odd, and they give good amount of dividend yield as well. Among the three players, HPCL could be better placed because they have that demerge of the lubricants business that could take place, which will unlock value out there. And also, as I mentioned earlier, the marketing volumes are higher than the refining volume. So the question is, OMCs look set for a solid quarter three. Will the street look through the quarter two inventory loss and then brace for a bit of a re-rating? Well, that's going to be the focal area. Mahesh, I wanted you.
Thank you for watching CNBC TV 18. For all our top stories and news updates, follow us on our social media platforms.